Namaste to all. Dear students, I am here with a video of ratio analysis. Yesterday, in earlier video, I have discussed about the ratios. Okay, so some of the ratios we have discussed yesterday. Let us see this summary chart of ratios. We are having first column ratio, next column formula for that ratio, and definition and terms what is included in that, and use and interpretation of that ratio. These are the things we are having. So let us have a quick recap of what we studied in earlier video. We were having liquidity ratios in the last video, so let me explain those quickly. We are having liquidity ratios or solvency ratios, short term solvency. These includes current ratio or working capital ratio, that is current assets divided by current liability. Ideal ratio will be 2:1. If we are having 1 rupee current liability, we should have 2 rupees in our pocket. That is the meaning here. What includes under current assets? Cash, bank balance, marketable securities, short-term investments, sundry debtors, bills receivable, inventories, prepaid expenses, etc. And current liabilities includes sundry creditors, bills payable, plus outstanding expenses, bank overdraft, short-term loans and advances, provision for tax, proposed dividend, etc. These will be there under current liabilities. So use it is used to measure the short-term solvency stability of the company to meet the current liabilities on time. Ideally, interpretation, normal or standard is 2:1. A high current ratio or very low current ratio is not advisable. This is what we need to see. Okay, it should not be more and it should not be less. That is having 0.5 or 0.3% or 0.3 is not required. Similarly, 5:5/1 is also high current ratio is also not very good sign. So we should have a clarity about this one. Next is liquid assets ratio or quick assets ratio. That is liquid assets or current assets is equals to current assets minus stock prepaid expenses. From current assets, if we deduct stock and prepaid expenses, we will get quick assets. And current liabilities similar to given above, that is sundry creditors, bills payable, outstanding expenses, bank overdraft, short term loans, provisions and proposed dividend, provision for tax, proposed dividend, all. So this is how liquid assets ratio or quick asset ratio will be used. It is used to measure the ability of company to meet its current liabilities at short notice. All of a sudden, so if we need to pay off our current liabilities, what should be it? And normal or ideal standard liquid ratio or quick assets ratio is 1:1. One current liability, 1 rupee should be in your pocket. A very high or very low liquid ratio is not advisable. Next we are having super quick ratio. Or uh, super quick ratio or absolute liquid ratio we will call, and liquid ratio is called as acid test ratio also, the earlier one. Super quick ratio is called as absolute liquid ratio also. So super quick current assets divided by current liabilities, ideally it should be 0.5 by 1. Super quick assets is equals to quick assets minus sundry debtors bills receivable. That means from current assets, if we deduct stock and prepaid expenses, we will get quick assets. From quick assets, if you deduct sundry debtors and bills receivable, you will get super quick assets. And current liabilities is as similar to the current ratio. To meet the use is to meet the ability of the company to at least some parts of its current liabilities immediately, and normal standard is 0.5 is to 1. A very high or low super quick ratio is not advisable. Interpretation purpose, whether it is current ratio or liquid ratio or super quick ratio, interpretation is same, but here normal or standard ideal ratio for current ratio is 2 is to 1, and quick ratio is 1 is to 1, and for super quick ratio 0.5 is to 1. So let us see the some profitability ratios one by one. Here we are having profitability ratios. In profitability ratios, first one is return on investment or return on capital employed or return on total assets we call. Okay. NP, net profit, that is earnings after interest and tax, including non-operating incomes and expenses. Or operating, this can be two types. One is net profit divided by capital employed, or operating profit divided by total assets into 100, you will get in a percentage. Sometimes he may ask return on investment. In that case we will take net profit into assets turnover ratio, that you will get return on investment. That is the note point here. So what is net profit? NP is equals to net profit, which is equals to earnings after interest and tax, including non-operating and incomes and expenses. Operating profit means earnings before interest and tax, excluding non-operating incomes and expenses. We need to take TA, total of all assets excluding fictitious assets. Capital employed, please remember this formula. How to get capital employed? Share capital, that is equity and preference share capital, reserves and surplus plus profit plus long term medium term loans minus fictitious assets or non-operating assets we need to exclude. So how you will get capital employed? The same thing we have done in this capital employed for the calculation of goodwill valuation in case of super profits method. The same thing here we need to follow. So if you see the balance sheet, shareholders fund, that is share capital plus reserves and surplus, and non-current liabilities also we need to include here, minus fictitious assets and non-operating expenses is the other way to remember capital employed. What is the use to know utilization of capital employed in the generation of profits of the company? कंपनी के प्रॉफिट्स के लिए कैपिटल को कैसे यूज़ करें ये बताएगा. द हायर दी आर ओ आई द बेटर फॉर द कंपनी. ये ज़्यादा रहा तो बेटर है. दिस इज़ हाउ वी विल राइट इंटरप्रिटेशन. These interpretation points are very important, which will change your answer from A to O, as I will tell. Next one is return on shareholders fund. Net profit divided by shareholders fund. From here onwards, you see net profit will be the numerator and the denominator is changing in each. Net profit divided by shareholders fund into 100 you will get as a percentage ratio. Net profit, as we studied earlier, earnings after interest and tax including non-operating incomes and expenses, that is interest income, interest expenses, those are non-operating expenses. Shareholders funds means in company type of balance sheet there will be shareholders fund, that is nothing but share capital plus reserves and surplus. Here we need to consider those itself. Share capital, equity and preference share capital plus reserves plus profits minus fictitious assets we need to consider. Use to show the profitability from the shareholders point of view. Shareholders amount invested is how much and how much profit is earned. The higher the return of shareholders fund, return on shareholders fund, it will be better for the company. Next ratio is net profit ratio or operating profit ratio. First we will see net profit ratio. Net profit divided by net sales into 100 you will get net profit ratio. Net profit is same, earnings after interest and tax including non-operating incomes and expenses. Net sales means sales minus sales returns. If you are calculating operating profit ratio, then operating profit divided by net sales into 100. What is operating profit means? Gross profit minus operating expenses. Operating expenses means expenses which are related to business, running the business. These expenses we need to consider. Non-operating expenses we should not consider here. Use to know the net profit or operating margin on each sales. How, what is the ratio between sales and net profit? It will tell. The higher the net profit or operating profit ratio, that will be the better for the organization. Next, assets turnover ratio, that is net sales divided by total assets. It will come under number of times. Net sales, as we know, sales minus sales returns. Total assets means all assets excluding fictitious assets. So this ratio is used for what purpose? అయితే నేను బట్ట to show the assets are utilized in generation of sales. How assets are utilized in generation of sales for the company, we need to see. The higher this ratio, that will be better for the organization. Next one is gross profit ratio. Gross profit divided by net sales. How to get gross profit? Sales minus cost of goods sold will be gross profit. Net sales is equals to sales minus sales return. To note the relationship between manufacturing cost and sales, this ratio will be utilized, and the higher gross profit ratio, that will be better, because if we have more gross profit, more income can be generated and we can have better net profit. Next ratio is total expense to sales ratio, operating ratio, that is total expense to net sales, total expenses divided by net sales. Total expenses is equals to cost of goods sold plus operating expenses. Net sales is equals to sales minus sales returns. Use to find out the cost content in the sales, how much cost is involved in the sales, and lesser the operating ratio, it will be better. We should not have much expenses, lesser it will be, that will be better for the organization. Next, cost of goods ratio, cost of goods divided by net sales. Material consumed ratio, that is material consumed divided by net sales. For labor cost ratio, labor cost divided by sales. And factory overheads ratio, factory overheads divided by sales. In each case, sales will be in the denominator, and in numerator, if it is of cost of goods sold ratio, we will take cost of goods sold. If it is of material consumed, we will take material consumed. If it is of labor cost ratio, we will take labor. And for factory overheads, we will take factory overheads. Use to find out the breakup of each cost of goods sold item in the sales. The lesser these sub ratios is, the better, because cost we are considering, so cost ratio should be less in the total sales. Next, operating expenses. Operating expenses ratio means operating expenses divided by net sales. Sometimes operating expenses, instead of operating expenses, administration expense ratio we can take. That for that, administration expenses divided by net sales we will consider. For general expenses, we will divided by net sales into 100. Similarly, for selling and distribution expenses divided by net sales. This is how expenses ratios will be calculated. So these are the ratios which are related to the expenses. Operating expenses includes administration expenses, general expenses, and selling and distribution expenses, not financial expenses. So to find out the breakup of each operating expenses items in sale, it is used, and lesser these sub ratios, that will be better for the organization. These are the various profitability ratios, and here I'll end the video, and along with this video, I'll send the this chart also, so that you can write it in your notes for better understanding purpose. When you write, then only you can remember the ratios. And please, I am telling, by heart these ratios, otherwise you cannot do solve the problems. So सीखना बंद तो जीतना बंद, तो सीखना चाहिए जीतने के लिए. And I request you all to be stay home, be safe and healthy. That is the remedy we are having till now. कोरोना से दूर रहना है, तभी वो हमसे दूर रहेगा. बाय, टेक केयर, जय हिंद.